Globalization worked in aggregate, right? US GDP per capita rose, Chinese GDP per capita rose, global inequality actually fell. Those gains were obviously not distributed evenly in the United States. That led to very significant polarization. I think it's as bad as it's been in history, and that leads to pretty extreme policy shifts and more extreme policy proposals. Tariffs are one of those.
I'd like to start today with a pair of quotes that are, I think, apt bookends for the beginning and the end of an era. For the first time, our companies will be able to sell and distribute products in China made by workers here in America without being forced to relocate manufacturing to China, sell to the Chinese government, or transfer valuable technology for the first time. We'll be able to export products without exporting jobs. Meanwhile, we'll get valuable new safeguards against any surges of imports from China. We're already preparing for the largest enforcement effort ever given for a trade agreement. If Congress passes PNTR, we reap those rewards. If Congress rejects it, our competitors reap those rewards. Again, we must understand the consequences of saying no. If we don't sell our products to China, someone else will step into the breach. And we'll spend the next 20 years wondering why in the wide world we handed over the benefits we negotiated to other people. That was President Bill Clinton in March of 2000 in a speech at the Paul H. Nitze School of Advanced International Studies at Johns Hopkins University. Fast forward to today, and here's a statement put out by the Chinese Embassy in Washington on March 4th, 2025. If war is what the U.S. wants, be it a tariff war, a trade war, or any other type of war, we're ready to fight till the end. I'm Amar Reganti, fixed income strategist here at Wellington Management, and this is the Investor Exchange. Today, I'm speaking with my friend and colleague Mike Medeiros, macro strategist here at Wellington. He's a student of policy, a tireless expert for me and investors across the firm. Mike, thanks for joining me today on the Investor Exchange.
Amar, thanks for having me.
Okay, you heard those two quotes. We've professionally lived those two quotes to some degree. I want to just really backtrack. After Liberation Day, if the tariffs that had been announced, outside of the White House had not been rolled back, the ghoul in me is curious on what you would have forecasted would have been the economic impact for the U.S.
I'll give you a short answer and a long answer. The short answer is a depression.
How do you define that? Because we haven't experienced that in our modern era, I guess.
Let's just say it would have most likely have been the worst recession since the 1930s. Unemployment rate above 10%. And the reason I say that is because it was very easy to map the direct impacts in terms of what it means in a growth and inflation perspective. What was harder to map was the uncertainty effects. And uncertainty, through some quantitative measures, was actually worse than it was during COVID in 2020, when obviously we saw the unemployment rate go well into the double digits. And so there's a fine line, I think in hindsight, where tariff levels, I don't know what the number is, but certainly at 145%, really lead to more of an embargo. And with China, that's what we're looking at. Consulting some of our consumer analysts, it was abundantly clear that trade was not just slowing, was coming to a halt in certain sectors. And that would have been obviously extremely difficult for the economy to handle.
Do you believe in the empty shelves theory at that point?
I have to. It was pretty clear from the meeting at the White House with the retailers that was a distinct possibility starting in Q3. We saw a lot of it in the shipping data, where the shipping data collapsed after Liberation Day and certainly after 145% tariffs went live. And so, the debate at the time was about recession or no recession, magnitude of recession. And barring a change, which obviously happened, it was looking more dire than that.
I've heard you in other venues where you and I have been together at describe almost what happened between those two quotes of President Clinton at Johns Hopkins describing this wonderful new era of openness, prosperity, and trade, and the Chinese embassy posting that they were willing to engage in conflict, however it may come. From your seat, as a macro strategist, how did we get from there to here?
The first quote you shared was probably one of the best ones you could have picked to define globalization. And globalization worked in aggregate, right? U.S. GDP per capita rose, Chinese GDP per capita rose, global inequality actually fell. Those gains were obviously not distributed evenly in the United States. That led to very significant polarization. I think it's as bad as it's been in history, and that leads to pretty extreme policy shifts and more extreme policy proposals. Tariffs are one of those. Tariffs, per the Trump administration, are supposed to entice other trading partners to come to the table and renegotiate trade deals. And they're also supposed to close the trade deficit through lower imports. And so in theory, that's essentially, I think, what's happened between those two quotes.
Okay, well, clearly there was a lot of market volatility in the days and weeks following the announcement in fixed income markets and equity markets as well. At a certain point, the White House and the Treasury Secretary gave signals that they were about to walk this back. And finally, we've had a meeting in Geneva where there's a significant rollback of China-related tariffs on both sides. How do we stand now? I mean, clearly not a depression from your perspective, but if we just took at face value where the levels are today, how do you think that impacts your view of inflation and growth going forward?
Yeah, so a week ago, the effective tariff rate was 26%. And as it stands today, it's 15%.
Is that just against, against the whole world, right?
Whole world. Yeah. Exactly. That is still the highest effective tariff rate in the United States in about 100 years, since the 1930s. And so to me, that still represents a very material supply shock that should reduce global trade activity, accelerate a worsening growth inflation trade-off in the U.S., but obviously we've seen this ebb and flow a lot since April 2nd. It did become clear that 145% tariffs on China just would not work in practice. You know, as I said before, you'd have more shutting off of activity, not a slowing in activity. And that, I've described it as destination versus journey, right? The destination you want to get to is unwinding globalization, is closing trade deficits. Very hard to do that in a few months. You can do that over a period of 5 to 10 years, but there are significant adverse consequences if you try to rush it. And so it seems like the decision from the Trump administration, which admittedly is quicker as it relates to China, is much quicker and is a much more significant climb down than I think anyone in the market, myself included, expected going into Geneva, I think helps that, right? It helps manage the process and put it particularly on more of a process-based path from here, which was missing in the month of April.
Like a strategic dialogue, effectively.
Exactly. And at a minimum, what that does for the market and for the economy is it doesn't extinguish the negative supply shock, but it puts some bands around it. It decreases the probability that as long as bilateral negotiations are going on, it reduces the probability that you get massive swings in the effective tariff rate. Because bringing it back to the uncertainty point, uncertainty works both ways, as it relates to trade. There's uncertainty over whether tariffs are going to go up tomorrow or in a week. And there's also uncertainty from a company's perspective of their input cost pressure, right? Is that going to come down or go up? And that's where uncertainty can really lead to less hiring, less CapEx, which is really needed at this stage in the cycle, and adverse growth consequences.
So this is a kind of clipping of the tail scenario.
I think so, yeah. And, I don't know what the effective tariff rate is that cuts off activity versus allows activity to go forward at a slower rate. 15%, is that manageable? Yes. Is it still really difficult? Absolutely. And so I think that's where we are right now, right? The market had got up to pricing at a 75% chance of recession. That's now back below 50. I think that's fair. You have to bring down the probability of recession, but certainly not extinguish.
You had mentioned earlier the concept of closing the trade deficit, or not fully, but shrinking it and changing it. Obviously, tariffs are a tool in that, but the things you seem to allude to, the common phraseology is industrial policy. Which leads me to DOGE, interestingly enough, because to some degree, industrial policy is a form of state capacity, the ability to manage a complicated way of protecting and growing certain industries. First, let's think about the fiscal aspects of it. You've been monitoring DOGE from day one. I know you've been following the website, independent sources, the data that put out by Hamilton Project, Treasury, et cetera. What do you think the impact has been of DOGE on the fiscal side?
So as it relates to the fiscal side, right, where has DOGE been powerful? DOGE has been powerful in getting rid of or firing federal employees. We'll talk about the fiscal backdrop, which is deteriorating significantly in a second, but A contributor to that is certainly not federal employment. Federal employment as a share of total employment is the lowest in 70 years. It's below 2% of total. And so DOGE was very successful at being able to fire federal employees. And we'll probably see that hit the labor market data sometime in the second half of the year. Where DOGE was woefully unsuccessful was in cutting spending. You and I talked about the market narrative back in late January, early February when DOGE was getting going. Fiscal austerity was a real theme in the market. And I was wrong about the impact of DOGE initially because I was just saying they can't cut spending. This comes down to Congress. I think that's been proven out now that we see the numbers. The budget deficit is wider. Federal spending is up year over year. We're on track to have a 6.5% to 7% deficit this year. But I think it caught a lot of people off guard initially. And then now that we actually see the data, it's been proven to be completely ineffectual in terms of slowing the rate of federal spending.
Well, there is a large reconciliation bill out there, which seems to hang over everyone in markets. There's obviously differences between what the House is putting forward and what the Senate is putting forward. But based on what you've been watching, what do you think this looks like, both in a tax cuts perspective and what spending might get cut and kind of like net? How are we going to come out of that process?
I think net, everything I've seen is pretty negative for the deficit in 2026 and even worse for medium-term debt levels. And I think if you take a step back, what are some key differences between Trump 1.0 and Trump 2.0? Number one is the starting point on inflation. We've been above the Fed's 2% target for almost half a decade now. Number two is a starting point on debt. Debt as a share of GDP is 100%, and we're running wartime and recession-type deficits in a time of expansion. And then number three is the bond market. The bond market has clearly priced in a lot of these risks. Term premium is higher than in the first term. The level of yields are higher, et cetera. And so I think that's an important backdrop for this reconciliation bill, because this reconciliation bill has kind of started off in a budget neutral type way. And when I read what got through the Ways and Means and Energy and Commerce Committee earlier this week, it's a lot of front-loaded stimulus. It's a fiscal impulse of about 1% in 2026, assuming it passes. It's another smaller fiscal impulse in 2027. And there's actually no fiscal tightening until 2030. And so from a debt perspective, right, I think the market is now in the process of revising up deficit and issue expectations for 26 and 27. Now, as you said, this can change, right? And I've said this Q4 of last year. Now I think it's much more apparent given rhetoric from the Trump administration. The governor on policy is the bond market. And we saw that play out in early April, where you saw pretty significant shifts on trade policy, pretty significant shifts in White House rhetoric towards the independence of the Fed, shift dramatically when 30-year yields were at 5%, 10-year yields were at 4.6%. And so this is an issue that the administration is aware of. And the question I keep coming back to is that, the other supply shock we didn't talk about is immigration, right? With demographic headwinds really coming through post-COVID, you can kind of fix those one of two ways. One is with higher participation, prime age participation rates at a 30-year high. The second is with higher immigration. And so with immigration levels slowing dramatically, and I think that'll show up in the labor force in the second half of the year, you expose a lot of those demographic headwinds, worse growth inflation trade-off on the services and the labor side. And so where does that kind of leave us in terms of the reconciliation bill? I think 10-year yields at 4.50, a version of this bill probably passes. If yields are 2 months' time, as they're still negotiating it, closer to 5% with signs of a negative reflex, the calculus could change. That's a very long-winded way of saying, I think ultimately the bond market will continue to play the role of the disciplinarian, not just for trade policy, but also for fiscal policy.
So, and one thing I guess I want to make clear, and this is just picking from what you've said, this is a stimulative bill.
Absolutely.
At a time when the economy is actually still in pretty good shape. I mean, it's cooling certainly, but it's still in, historically pretty good numbers as we think about forecasts for GDP and so on.
Definitely. The way the bill is constructed is most of Trump's proposals for new tax cuts have been added to the bill. And a lot of the spending restraint that came out from the House's first draft of the reconciliation bill has been pared back, particularly Medicaid spending.
Is that pushback from the Senate or just vulnerable?
I think it's pushback from the Senate,
Okay.
100%. And so can this bill change? Absolutely, right? It's not even through the Budget Committee, right? There are debates going on in the House right now about the SALT cap, about the extent of Medicaid cuts, and they can only lose 3 votes. And so one thing that's been surprising to me so far is how smooth the process has been. Having been through a number of these before, you always have to allow for 1 or 2 failures before ultimate enactment. Now, while that bill, I think, is stimulative as it's written right now, could it change in the Senate? Maybe. It's possible. But I think there's more of a timing issue, that I think the goal is to pass this by the August recess. And why I say August recess is because of the debt ceiling, because they want to incorporate the debt ceiling in the reconciliation bill. If you can't pass this by the August recess, then it bleeds into government funding in September. That's when you could shift to a 2-bill approach. And with the first bill, pass a debt ceiling, increase defense spending and border security by about $300 billion, the initial Senate plan, and then pivot to a second bill where you would have to fund the government in September to unlock the reconciliation. And then it becomes a timing issue because the deadline for the TCJA, or the Tax Cuts and Jobs Act, is December 31st. And if you can't pass something, given the progress they've made by August, very hard to see passing something as stimulative in the second half of the year after a failure.
What do you think the policy community is missing as this bill is being negotiated?
I see a lot of parallels in the process and the justification to Trump 1.0. And I think a potential unknown risk relative to that backdrop is the impact that rates can have in crowding out potential benefits from this fiscal bill. As I said before, we're at a very different starting point for debt, deficits, inflation, and interest rates. And if this bill goes through and does increase the pressure that the economy gets back above trend, and inflation picks up, the bond market, I don't think, will ignore it. And the bond market, as we've seen multiple times, has the potential impact to crowd out some of the positive benefits from the bill.
So the last question I want to get to is, you mentioned timing, and I think of Jay Powell. So one of the single biggest macro events, which is the reconciliation bill, is at best expected by the August recess. Unless he sees, and tell me if I'm wrong here, real substantial weakening in the labor market between now and then, I would almost feel like this Fed, and as it has been before, would be pretty cautious about easing. And they won't say it necessarily, but there's this huge outlier event that could change, all of their calculations.
You throw at the economy 2 negative supply shocks. Starting point on inflation is still above target, been above target for 4 years. And then add in 1% fiscal stimulus. That is a very tough backdrop to argue for cutting. And there's about 100 basis points of cuts priced in over the next 15 months. If anything, I think it would argue for the Fed to be on hold, but certainly more guarded towards inflation. And one of the things Jay Powell has talked about is they know tariffs are at least a short-term inflation issue. They don't know about the medium term. Econ 101 would say it's actually disinflationary over the medium term, one-time price level shock. That doesn't account for the starting point on inflation. It doesn't account for inflation expectations, which are adapting.
Input costs, that things move back and forth.
Exactly.
Yeah.
Input costs, and it certainly doesn't account for another supply shock going on in the labor force and additional fiscal easing. And so if you just took the fiscal bill in isolation, it would actually argue they should be hiking. So that's what kind of leads me to conclude that while you have to be aware of the impact that this could have from a cyclical perspective, from an Econ 101 perspective, the timing and provisions and amount of stimulus given the context, there's a lot of room for it to be walked back as well.
Well, it should be an interesting spring and summer as we all watch that.
Absolutely.
Mike Medeiros, thanks for joining us here today. It's been great, as always, to talk to you.
My pleasure. Thanks for having me.
The Investor Exchange podcast is a production of Wellington Management. Our producers are Mark Murphy and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Production support from Dave Crow and Rasa Sermont. Animation support from Rasa Sermont. You can listen to The Investor Exchange at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.